thank you so much for having me. Thanks to Investor Inspiration for having me too. And of course, thanks everybody for being here today. I appreciate you taking time out of your schedule. Today I want to introduce you to trading trends for both short-term and longer-term gains. Before we do that, there's the obligatory disclaimer screen. You can read it on my website if you really have nothing better to do. But I like to just sum it up. All predictions are about the future, and a lot of stuff can happen between now and then. I'm not going to spend any time telling you who I am. I think Reed did a pretty good job of that. I do want to tell you a couple things about my methodology. I'm not going to bore you and go through all of this because if you've seen me before, you know I talk about some of these things. Just one or two things I do want to touch upon. Not a get-rich-quick scheme. There will be some losses, but you win by surviving the bad times relatively unscathed, and you do exceptionally well in the good times. It's a trend-following methodology. The market has to trend, just like you can't get can't get a tan when the sun's not shining. You can't catch a trend when there is none. So it doesn't work well in choppy markets, but what you do in choppy markets is you end up sitting on your hands. One thing I just want to show, two more things in this slide I want to point out. One is a repeatability to this. I didn't realize how important this was until I did a webinar a couple years ago. Got a phone call from the host a couple minutes later and said, let's talk about this repeatability thing. And we got to talking, and I didn't realize how important it was, but repeatability means that if you're studying my methodology or if you're following my trading service directly, you should be able to do as well as I'm doing. It's like you don't need some sort of account set up in Nigeria that does something with U.S. equities that's a little bit, let's just call it gray area over here. You don't need some sort of high-end institutional platform to where you've got to get your executions down to the exact penny. It's not that crucial. So there's a repeatability to it. And I'm not picking on some of these people who do well with these type of methodologies, but I know in some cases if you're trying to follow a day trader who's in and out 50 times a day, by the time you're getting into a trade, he's already getting out of a trade. And we will hold trades, as you'll see. I don't want to spoil it, but as you'll see in a few minutes, for days, weeks, and sometimes even years. I do prefer daily. This is one thing I want to mention too, because it'll save a question at the end. I prefer daily charts and I prefer stocks. And there's a reason for stocks. It's because their stocks tend to be more inefficient than other markets. I will trade other markets such as Forex, but keep in mind that it's a very crowded playing field in those other markets, and I think you're much better off looking for inefficiency in something like stocks as opposed to trading these other markets. There are occasional opportunities. That's kind of like lesson 201. If you email me, I'll give you some patterns and when to use them on those markets. But for now, and for this presentation, we're going to focus on stocks. Okay. The question is, should you trade for short-term or longer-term gains? Now, no matter what anybody tells you, only the short term can be predicted with any degree of accuracy, okay? As I said at the beginning of this presentation, kind of tongue-in-cheek, all predictions are about the future. A lot of stuff can happen between now and then. Well, that's true when it comes to markets. It amazes me that these people will get on TV and say, oh, this market's going to be higher a year from now. Well, if they do that, they should sell all their worldly possessions and put them all into the market. The problem is we don't know that. You can only predict the short term when it comes to the market. It's kind of akin to predicting the weather. And as I like to say, if it's cloudy and thundering outside, you know there's a pretty good chance it's going to rain soon, but you don't know if it's going to be raining this time next week or this time next year, obviously. The great thing about short-term trading is your risks are much better defined. A market can only move so far in general in a short amount of time. Unfortunately, the downside is the market can only move so far in a short amount of time. It just doesn't make enough money. The real money is in longer-term trends. So again, longer-term trends is where the money is. Unfortunately, the longer the forecast, the less accurate you will be, and losses and drawdowns are too large. Now, I'm not going to mention any names here, but there's been a lot of things written about these famous long-term trend traders and how much money they've amassed trading very simple systems. And not to take anything away from them, but if you do some Googling, you'll find out that a lot of these people have subsequently blown up. And that's because your accuracy is going to be very low with longer-term trends, and your drawdowns are just going to be abysmal. I was reading one book where somebody was following a system that had a 70%, that's 70% drawdown. As far as I'm concerned, if you lose 70% of your money, you're pretty much blown up. So what's a trader to do? Should you trade for shorter-term gains or longer-term gains? And my answer to that question is yes. So why not have your cake and eat it too? Trade for a small, quick gain, but be willing to stick with the position as long as it moves in your favor. And this is one that's set up a couple of years ago. Most of the trading that I do is pullback related, and we're going to talk quite a bit about this arrow here in a few minutes. But we look for a pretty solid trend, something that's pretty obvious, and we look to trade a pullback in that trend. So this one triggered, it's a bit of a dated example, but it did stay in the portfolio for about 2.5 years. Now there was a little, if you look right here, it's kind of hard to see, a little blip higher. We took some partial profits because, hey, we don't know if that's all we're going to get. Sometimes the market rallies up out of a pullback and we get just a little bit of a profit, then it comes right back in, and sometimes it rallies out of the pullback and it keeps on going. So we don't know if it's going to do this or this going in, so we use a trailing stop and we take partial profits along the way. Now here's a more recent example. This one is actually still open. This one was triggered back in 2013 on a pattern I call a bow tie. If you email me, I'll give you the pattern. Or if you look under my website of education, you can probably find it there also. It took off, and we took partial profits right around here. And to those who wrote it out for the entire day, on that day, you got a little bit more out of it. Well, actually about 25% more. It was a pretty big day. But it really pales in comparison to what this stock has done longer term, and now it's up around $35 a share or so. Now, I mentioned inefficiency a few minutes ago with stocks, and not with all stocks, with certain stocks. If you could find a little solar stock like this that has the potential to make a large move, then you can make a lot of money in this longer-term trend. Now, when I did a stock selection course a few months ago, I spent about an hour or so just talking about inefficiency. Obviously, we don't have much time today, but just know that something that's a little bit thinner in stocks, meaning that the volume is a little bit lower on average, okay, has the potential to be an inefficient stock. So this stock went up about 700% total, okay? So that's a pretty inefficient move. Efficiency means everything's priced in. So if this was an efficient market and you were looking at it back in December of 2013, it might be a little higher or a little lower a year from now, I should say, but it shouldn't be much further than away from $5 a share. But as you can see, it ran up about 700% if you're counting more current prices in here. So that's a very inefficient move. So if you could ferret out these inefficient stocks with some of the patterns I'm getting ready to show you, you can capture some really nice moves. Doesn't happen every day, doesn't happen in every position, but if you set yourself up for these occasional outliers, you'll do just fine. Here's another example of a nice move where and I'll show you the pattern here in just a few seconds. The stock triggered here. Didn't do a whole lot right away, but we stuck with it. And then right around here, we were able to take partial profits, trail a stop higher, and this one stopped out at about 150% gain. Now, so the question is, why trend follow? I guess we should have answered that a little early on. Well, it's where the money is, okay? Even if you're a contra-trend player, you have to be a trend follower for at least some length of time. Otherwise, you would not get paid. So my point is, why not be a trend follower all the time? Obviously, if you buy a market at point A and you sell it at point B, your profit is B minus A. Or if you short it at A and you cover at B, your profit is A minus B. Now, notice I drew an arrow on both of these charts between A and B. What is from A to B? Well, that's a trend. So if you're going to make a profit on a trade, you have to catch a trend. Now, my methodology is obviously not the only way to trade, but it's the best that I've found after many years of searching. It's a very simple approach to the markets. I have clients come in all the time, and they do incredibly well when the market's trending. And then the market begins to chop around, and we all kind of go through a bit of a drawdown, and not a whole lot happens, and we end up not doing anything, and that mitigates the drawdown. But usually when it gets choppy, a lot of those clients leave, and they go off to chase rainbows, some exotic system. Some guy says you could just make money while you sleep, trade 5 minutes a day, blah, blah, blah. And they go off and they try all those systems, and they do some research on their own into all this crazy stuff. I'm not going to mention some of the methodologies that just flat out don't work, that are promoted out there as being viable, and it's just a scam. And they go out and do that, and then they come back and say, you know, Dave, I realize now there's no holy grail. Your stuff is not perfect, but nobody's is. At least with this methodology, we can define the risk, we can control the risk, we can keep the drawdowns within reason, and then when the market trends, I get it, we can print some money. So here's the thing. If you have your own approach, it's not my way or the highway, okay? Take some of my stuff, take some of my patterns, and make your patterns even better. Take some of the things that I do with the money management, with the position management, and incorporate that into what you do, okay? Kind of Dave a la carte, and I'm totally cool with that. Now, if you are new to trading or switching methodologies to a methodology like mine, a couple things. You want to trade at a small size, you want to trade only one pattern until successful, and then you want to slowly build. It amazes me, if you're not successful with one pattern, you're not going to be successful with 10 patterns, okay? So just take your time. And I do answer all my own emails, okay? So you can shoot me an email if you have any questions. Again, it's a simple approach. One should not increase beyond what is necessary. The number of entities required to explain anything, and that's Occam's razor. A better way of putting it is simplicity is the ultimate sophistication, and that's Da Vinci who said that. Let me just show you the methodology in a nutshell real quick, and then we'll hurry up and we'll get to a couple of patterns here. First of all, you want to identify a market that has a strong trend. Very important, but there's various ways to define that trend. I prefer not to use indicators, although I will show you moving averages here in a few minutes, which can be useful. But ideally, you want to be able to draw a big arrow on the chart, and then we're waiting for a correction, or otherwise known as, aka, a pullback. And then we're waiting for an entry. If that market rallies up and doesn't trigger, we just avoid a losing trade. Now, in more recent times, this is a little bit more advanced discussion, but in more recent times, I've used a more liberal entry, and that has kept me out of a lot of trouble. Markets will rally up, they won't trigger, and they come right back in, and then I stay out of a trade. By the way, I'm going to use the word market and stock interchangeably, okay? But I am mostly referring to stocks in this presentation, but I do believe that markets are markets. It's just some markets, like stocks, tend to make better trading vehicles than others. Now, let's say we do get triggered into that trade. First thing we're going to do is we're going to put in a stop. We know we can be wrong. One advantage I have in having an educational business is I see a lot of people make a lot of mistakes, and it's a constant reminder to me, hey, dummy, don't do the same thing, okay? So just admit going in that you might be wrong. I spent a whole hour this morning talking about the psychology of admitting that you might be wrong in planning your trade. And if you need that webinar, shoot me an email. I'll let you know. I'll get it uploaded to YouTube for you. Anyway, if this market does begin to rally, if we're fortunate enough, we'll catch that little swing trade profit out of there. I'm slotted as a swing trader, but as you just saw, I will hold positions for weeks, months, and occasionally even years. And what we'll do is we'll trail that stop up. Now, on the first low, from the first half of position, we're trailing that stop fairly tightly, okay? And if that trend does begin to materialize, if this market begins to trade way out here, then what we'll do is we'll gradually loosen up the stop, often by not doing anything. We're not going to move the stop down. We only move the stop up, okay? But sometimes, let's say the market moves up this much, we might not move that stop up that much. We might just move it up a little bit and gradually let that widen down. So what we're doing is we're changing hats from a swing trader to a longer-term trader, but we already sold out on half of our shares, so we already took a profit, And now we're just managing the open profit, and that's where the real money is in those longer term trends. So I'm kind of anti-reversion to the mean trading. Reversion to the mean trading means that a market is oscillating like this. You're trying to sell it when it's high and buy it when it's low. And the problem with that is it's akin to like walking a dog on a leash. The dog wanders back and forth. And every now and then, though, that leash breaks, metaphorically. So it's a very dangerous way to trade. But one of my clients pointed out that I am playing reversion to the mean within an established trend. In other words, I'm playing a pullback. So I am looking for that market to pop back up towards its old high so I could take a swing trade profit. If the pattern is there, and ideally if the sector's backing up the pattern, meaning the sector's also trending and ideally set up, and if the overall market is trending in the right direction, the same direction I should say, then there's no guarantee, but there's a fairly certain chance that that market might just pop up enough for me to get a little profit out of it. Now, what's uncertain, even if all those other things are all in line, is a resumption of the longer-term trend. So we don't know what's going to happen then, but we could stay with that market as long as it moves in our favor. Hopefully weeks, months, and hopefully, especially hopefully, years and years, okay? So it all boils down to identifying a trend or a significant change in trend. We don't have enough time to get into emerging trends today, but that's the bow tie pattern I mentioned earlier, first thrust pattern, those type of very early trend patterns. We just had a first thrust down in the energy stocks. We could get a bow tie soon in energy stocks. The REITs just rolled over. We had the thrust down there. If today's weakness continues, we could see some additional transitional patterns really quick. And then once you identify that trend or significant change in trend, or that emerging trend, I should say, then you enter that trend on a pullback. Money and position management are key, and the psychology, the ability to follow and execute that plan. As I said, I spent an hour earlier just talking about psychology and wrote about 3 pages on my homepage on my website just on psychology today. So you have to have the ability to follow that plan. I know it's cliche, but you need to plan your trade and trade your plan. You'd be surprised how many people approach trading without any planning whatsoever, and if they do plan, they don't follow their plan. So I would strongly encourage you to get disciplined, plan your trade, and then trade your plan. Now I'm going to rush through this fairly quickly. I just want to show you some things to look for in a trending market. Obviously, at point A, this is not a trending market. One of the simplest things to do, and it never ceases to amaze me, is you look at where a market closed, and you look at where a market closed. Let's say you come in on this day here. You look at where the market closed, and you look back about a month and see where the market closed, okay? And if you can connect a straight arrow between those 2 points, that market is not trending. I get asked all the time about stocks that look like this. They go up, and they look like this, and then the stock is like, might be like right here. Hey, Dave, I'm thinking about buying this stock. Look, it ran from here all the way to here. Is that a trend? It's like, well, yeah, that's a trend, but if you look carefully, you'll see that it hasn't made any forward progress in 2 months. So never forget about net change just by looking at the closing price. And that'll keep you out of a lot of bad trades. Now, here we have a base breakout. I'm not a breakout trader, although I have found some breakout patterns that do work in IPOs, because IPOs have a little bit more euphoria behind them. But as a general statement, in established stocks, a breakout is not going to work, or not going to work well. If you are going to be a breakout trader, make sure you get your head wrapped around the fact that you're going to be wrong a lot, because everybody and their brother's going to see that breakout. Although this one worked in this particular example, they won't always work. Notice that this stock begins working its way higher, and it tends to go up day after day. We're going to talk about persistency in just a few minutes, so I'll save that for that conversation. But notice that it persists higher. Notice that it begins to have some wide-range bars, meaning that the bars kind of started small, but now they're beginning to enlarge in the direction of the trend, okay? Notice its gaps. Notice that the closes are getting stronger, meaning that the closes are towards the top of the range. That means that people aren't selling it at the end of the day. Maybe some people are buying it at the end of the day to support that market going into the close of the market. And then we've got quite a few gaps again, strong closes, gaps, etc. And then also notice that this trend has persisted higher. You can almost draw a line through nearly every bar. And then at this particular point in time, it begins to accelerate higher. You got strong closes and wide range bars in here. But then look what happens. It gaps higher, and that's a good thing, and it shoots even higher, and that's a good thing too. But by the end of the day, notice that we have a weak close. It closes way down here, almost on the bottom of its range. It tries to gap higher, forming a lap, meaning a gap that doesn't take out the prior high. And then what happens? We have another poor close, and then another poor close, and then it pulls back a little bit. And this is actually a setup I call a first thrust. This is the first thrust down in this stock, and you would actually look to short it here. So you'd ride out the trend, probably get stopped out right around here, and then look to ride out the downtrend. This stock no longer exists if you're trying to look it up. It went bankrupt. So that was the ultimate top in this stock. I like to use this example because it gives you a very compressed example of a trend developing and ending all within a few months' times. Now, I talk about trend qualifiers. Those are what I just talked about, the strong closes, the gaps and laps, the wide range bars, the fact that the stock's making higher highs and higher lows, okay? All those things help to identify the trend, and ideally that trend, you want to see some sort of persistency in that trend, meaning that it tends to go up day after day after day, or it tends to go down day after day after day. Mathematically, that's equivalent to linear regression, but I just like to draw a line through as many bars as possible. Now, moving averages can be useful for keeping you on the right side of the market. Keep in mind that any indicator is a derivative of price. So if you're using a moving average, it's going to have some lag to it. So I like to see an indicator as an illustrator, meaning that it's going to show me what's in the chart. It's not going to indicate what might happen. And a lot of times, if you're looking at a chart and you're not sure which way it's headed, you throw a moving average in it, and that moving average might look something like this, might actually have rolled over. And if you're just looking at the chart, you might think, like I said earlier, it might look pretty good on a net-net basis, but then when you look at it on a shorter-term net-net basis, you'll say, oh, aha, I see it's lost some momentum in here, and maybe it is rolling over like the moving average is suggesting that it has, okay? So just be careful with moving averages or any other indicator. I don't use any oscillators. I don't use any RSI or anything like that. I know people that use them. I think those who are successful with it are probably good chart readers to begin with. I've sat with people before and they get a signal and I'm like, well, why do you take the signal? Well, I don't like what's going on in the chart. It's like, well, why are you even bothering with this oscillator down there? Why not just read the chart? Two quick concepts with moving averages that are very powerful. One is slope. Now, I just said that moving averages do have daylight, so you can see that this market, the moving average is kind of flat in here, but it did begin to increase a little bit, so you can see you got a nice slope in here, an upward slope. So that's a good way to determine trend. An even better way to determine trend, which has zero lag, okay, is to look for daylight, meaning that the lows of the market are higher than the moving average or lower on the downside for shorts. So that's kind of a neat little thing. If you do some Googling, you probably find it on the internet. I wrote an article in 1995 for stocks and commodities. You get it directly from stocks and commodities if not. Called the 220 EMA breakout system. It was a system designed for trading currencies. And all we were doing was looking for a market to break out, or a two-bar breakout from a 20-day exponential moving average. And one of the readers coined the term daylight, meaning that the lows are greater than the moving average. So that's all we were looking for pretty much, was a couple of bars of daylight to look to get in on a trade. Now, getting back to our prior example, notice that we had daylight here. Notice that the moving averages were in proper order, or at least turned to proper order, meaning that the 10-day was greater than the 20-day, greater than 30. By the way, this is 10 simple, 20 exponential, and 30 exponential. These are both what I call the bow tie moving averages, which I use with my bow tie pattern. And notice that you've got the proper order, meaning that the shorter term or above the longer term moving averages. Notice you've got plenty daylight in here. Other than this one little bitty tiny kiss of the 10-day right here and right here, for the most part, you had daylight during this whole trend, okay? Now, Also notice you have positive slope, okay, in the moving averages. Now notice that when this trend begins to change, these moving averages begin to turn down. Now, the exponential moving average will catch up to price much quicker than a simple moving average, but it's still going to have lag. So if you're sitting around waiting for these moving averages to cross back over, this stock might be down at $10 a share, and you may have missed 90% of that move. So always be careful with moving averages, and don't use them in and of themselves. Although I will say the concept of daylight can be powerful. So if you can use just moving averages in and of themselves, make sure you use daylight. Don't forget to draw your arrows. This is on the back of every business card of mine. If you want a business card, shoot me an email and give me your address, or send me a self-addressed stamped envelope. I'll shoot you the address in my email, and I'll be happy to send you one. You ever get lost in the market, hold this up to your monitor and say, hey, is this market an uptrend, a downtrend, or a sideways market? Now, I know I joke a lot about this, but you'd be surprised how many people send me charts that look like an electrocardiogram, okay? By the way, the bull's not having his way with the bear, and the bear is not smiling. A lot of people say that. When I was just getting started, I didn't put a whole lot of money into my graphic artist, and that's what I ended up with. Okay, my setups are based on 3 phases of trend: trend resumption, trend acceleration, and trend transition. Trend acceleration, trend resumption is what we've been talking about all day. It looks like that. Trend acceleration is when a market takes off. It goes pretty much straight up. And then trend transition is when a market begins to roll over, and you're looking to play that first pullback as it rolls over. Today we're going to focus on trend resumption, and we're going to look at 2 of my favorite patterns there. Now, my favorite patterns for trend resumption are TKOs and persistent pullbacks. A trend knockout, you're looking for a market to be in a solid trend. Again, you should be able to draw an arrow. And you're looking for that knockout bar. That knockout bar is going to knock out the weak hands, the Johnny-come-latelys that might have just bought the stock very recently. It's also going to attract some eager shorts who don't believe the stock deserves its valuation. And when these players are knocked out or sucked in, however you want to look at it, longs versus shorts respectively, it helps to clear the way for the stock to trade higher, so you can capitalize on the predicament of these traders. Now, keep in mind that everything I do has some sort of concept behind it. I'm not going to say that, oh, this is the 3rd wave or the 4th wave count of the 5th moon, you know, or something like that. I'm going to say, well, wait a minute. Some people probably got knocked out of this trade, but it still looks like it's trending. Let's look to get in if the top of that knockout bar gets taken out, because anybody who got knocked out might want to come back in. Anybody who shorted this stock is going to be a hurting pup when that trend resumes, so they might be forced out, and the predicament, again, of those traders is going to help push that market higher, okay? You can see right here, this market was in a very, very nice trend, and I've got a better picture of it, or a snapshot in a minute I'll show you, but notice that it had this knockout move, and then it triggers, and then you get a very nice resumption of that trend. Let's check out a couple of more examples. Here we go. This is the shorter term version of what just happened. You can see you've got this serious trend here. You can just draw an arrow. It's also very persistent for the most part. You can draw a line through most of the bars here, and then you get this wide range bar down. It's got to take out at least 2 lows, but don't get too caught up in the semantics on that. Just know that this bar should be big enough to where it would have maybe knocked you out if you were in that trade. I've been in trades before, and a nice little trend like this, all of a sudden, bam, big knockout bar knocks me out, and at the end of the day, I'm actually looking to get back in, or at least on the following day, I'm looking to get right back in, get right back on that horse. You got knocked off, look to get right back on, because it really didn't do anything wrong. It just had a little bit of a shakeout move, and that's what a TKO is. By the way, this is a variation of the pattern I call an arbalist TKO. It's where the market gets stretched to the upside and then stretched back down to the downside. An arbalist is this medieval mechanical device that's like a crossbow times 10. So I was looking for a name like crossbow or something on it, but this market, it gets stretched really hard to the downside, then it springs right back. It's a really cool, one of my favorite patterns, especially when it comes to the TKOs. Here's another example. A while back, rare earth stocks were just on fire. And you can see this market's fairly persistent. It's also kind of accelerating higher, and you get this nice little knockout move. It triggers. Didn't do a whole lot at first, but then it's off to the races. And then this is the more recent example. This stock began to accelerate higher. And this move is almost a little bit too extreme, but I liked it because it closed way up here. So that tells me that, okay, there was some kind of bad news or something that came out on this stock. But by the end of the day, it looks like most people really didn't care about it. And then somebody came in and bought a bunch of shares. So I thought it was just a wonderful TKO to trade. And we had, you can see, this is it enlarged right here. You had the wide range bar down. It triggers. Didn't do a whole lot at first, okay, but then we did get our partial profits out, and then we were able to trail a stop on this one, and it went up about well above 200, I think to about 211% before coming back in and stopping out. Okay. Oh, here's the actual stop, but the stop actually went much further than this. And again, notice that this trailing stop, we're letting it widen out as the market gets higher and higher, and that's how we stay with these longer-term trends. And I never thought about it too much. I thought it was a pretty simple concept, but I've had a lot of people tell me, wow, Dave, that's really a cool thing. That's really a neat thing you're doing by letting those stops widen out. I never thought I could let those stops widen out and also trade that longer-term trend. So sometimes I take these things for granted as being simple, and it's kind of like knowing that Pinocchio is a bad motivational speaker. I thought everybody knew that. I see potential in you, and you. It's like the Geico commercial. Everybody knows that. Well, evidently everybody doesn't know that. So that's why I make sure I'm telling you these things today. It can be a very common pattern, so you want to search for a very, very strong trend, and ideally, as I just showed, a persistent trend. Make sure that knockout move is meaningful. Ask yourself if I would have gotten knocked out of this stock if I would have been trading it. And like I just said earlier, sometimes you get knocked out, and then you end up back in the trade like later on the next day. Okay. Sorry, I tried to multi-process for a second. It didn't work. It could be a good pattern doing blow-off moves. Sometimes the market will take off, have a pretty serious knockout move where everybody thinks, okay, this thing for sure has topped, and all of a sudden turns around and goes right back up. Okay, now I want to talk a little bit about persistent pullbacks. And all we're doing with persistent pullbacks is we're looking for a market with persistency in it, meaning that it tends to go up day after day after day after day after day, okay? And you could draw a line through most of the bars. Instead of drawing a trend line under the market, draw it just through as many bars as possible. And again, mathematically, that's equivalent to linear regression, but I just prefer to keep it simple and draw a line through as many bars as possible. And then you look for a pullback, and you look to get long. Now, this TKO we're looking at just a minute ago, and that CLDX was actually a persistent pullback. My trend line was drawn a little bit. I just drew a new one a few minutes ago because this line's a little bit closer to the median point, but you can see that that market is pretty much going straight up day after day after day after day. So you look for some sort of knockout move or some sort of pullback before looking to enter on that persistent pullback. And then our little friend VIPS, which was a Arbalest TKO, was also a persistent pullback. Notice that it's gone up day after day after day after day. You had here, you had a little pullback here, and then it took off again, and then you got a TKO. So persistency, again, just draw a line through as many bars as possible. You don't see too many of these on the downside, and that's because when a market rolls over, it tends to just roll over like that. Everybody rushes to the door at the same time. What's the old Wall Street adage? Stocks take the escalator up and the elevator down. Well, that's pretty much what happens. But every now and then you get a rare case where you will get a persistent pullback on the downside. A couple of notes real quick. The great thing about them is they're self-regulating. If this market gets choppy like it has been lately, it's going to be very, very hard to find a persistent pullback. I've got one stock I'm looking at right now. It's a persistent pullback. But there's not a whole lot of stocks that's persistent. So this one pattern is going to keep you out of the market when conditions are less than ideal. In fact, if you go back to, I say this all the time, if you go back to 2009, you can look at the, 2008, the bear market of 2008, it would be nearly impossible to find a persistent pullback on the upside. So you would have stayed out of the market, and you would have accumulated a few shorts even with this pattern, you would have beat probably 95% of all money managers with this one pattern, because 95% of all money managers just rolled the market all the way down as opposed to getting out of its way or even shorting, okay? Great place to start, and they're a great place to come back to. Let's say you're having trouble trading, you started doing all this crazy arcane stuff, and you're losing your butt. Stop doing all that. Come back to a very simple pattern. Get successful again with a simple pattern, and then start building from there. If you only traded one pattern, I think this would be it. And then it's especially powerful when combined with the persistency in the market and the representative sector. Now, I threw a lot of stuff out at you. There's actually a few more things. If you understand the nutshell screen, you understand most of the methodology. The rest is just details. There's some more patterns. I touched upon a few of those. Stock selection is crucial. I spent about 14 hours on a course just on that back in December. That's, if there is a missing piece to this, it would be the stock selection course, trying to pick the best, how to pick the best stocks. And we touched upon a lot of those concepts just a little while ago, the persistency, the wide range bars, and the direction of trends, and things like that. As you fully understand the methodology, a little discretion goes a long ways and makes it a lot better. There's a few more techniques with money management, especially when it comes to discretion. You don't have to do everything always perfectly to a T. If a market rallies up, for instance, and you're within a few cents of a profit target and the overall market starts coming in, the stock starts selling off a little bit, then by all means take those partial profits. You've got a brain in your head, use it, okay? And then obviously we talked a little bit about psychology. Number one thing, ability to follow and execute your plan. That's a big deal. If you boil it all down, it's make a decision and living with them. So make those decisions first and then learn to live with them. And it's much easier to control your emotions or keep your emotions in check. I should say embrace your emotions. You don't want to control them. You want to embrace them. That's a whole other conversation. But it's much easier if you understand the methodology, both good and bad, and if you're trading at a small size to where any particular trade or loss on a trade doesn't have a material impact on your life. So in conclusion, trend is your friend. We want to look to play pullbacks in obvious trends or obvious changes in trends, which would be an emerging trend. And we want to use money and position management to help us capture both short-term and longer-term gains. If you like what you hear today, I got tons of free stuff on my website, plenty of information there. Keep you busy for a long, long time. We've got a lot of YouTube videos too. In fact, I just did put one up a couple days ago on setting up your screens for trading. Getting a lot of good clicks on that, a lot of good comments. I do free weekly webinars. They run about an hour and a half, and it's every Thursday at 11 Eastern. And what else is going on? I've got the stock selection course, an IPO course, and then I have a trading service. I have 10 years of free archives if you want to download every single recommendation I made, every single ancillary setup that I mentioned each day. If there's a setup that's viable, I'll mention it, and I'll also mention some ancillary setups. So you can download 10 years of those, look at all of those charts, and that's a wonderful exercise if you want to learn the methodology. And then also, obviously, I have a store on my website which has all this in it. So if you just go to that link and check it out. When you do go to the website, sign up for the daily newsletter. I'm not going to spam you. I'll send you out a newsletter every morning, which will give you the webinar schedule, and will also give you my daily thoughts on the market, just kind of a brief overview. And then sometimes I'll get a little philosophical, like today, and I'll write a little bit about psychology or some of the other trading aspects. That's all I have, Reed. If you want me to take a couple questions, I'd be happy to do that. I don't know if you want to read them to me, or do I?
Yeah, absolutely. You have a couple minutes actually to answer a couple of questions. So if you want to present that to the room, it's all yours.
Sure. Okay. The question is, why not use candlestick charts? And my problem with the candle people, and I'm friends with a good friend who actually went to Japan, studied the candles, and actually has written books on candles. But even he'll tell you, his name is Greg Morris. Even he'll tell you that there's probably an overuse of the candles. It's like everybody's like, there's always a pattern in the market. Like, oh, it's three babies with a poopy diaper, or the banded baby with the wrestler. It's like every little thing it turns into something much bigger than it really is. It's not always a change in trend. It's not always a pattern in the market, and that's my problem with the candle people. Now, the long-winded answer of why I don't use candles is I would use them for a brief period of time, had some difficulties with some of those things I just said, and then I was fortunate enough to hook up with some old-school traders who were using Western charts. So in order to be on the same page, I abandoned the candles, and then I never went back, okay? But to each its own. It's not my way or the highway. If you're happy with it, then by all means, use candles, okay? All right, I'm trying to, let's see what else we have here. Okay, looks like some of these might be for the last guy there, last guy that was in here. My email address is dave@davelandry.com, and here's my contact information. This phone actually rings on my desk. I do answer my own phone. I get a lot of solicitation, though, so if you end up with the voicemail, it's probably caught me in a day with a lot of solicitation, so just shoot me an email and say, hey, Dave, can you pick up your phone? I'm going to call you in 5 minutes. Okay? Yeah, if you're using candles and you're successful with it, and that's what I tell everybody, if you have your own methodology and you're successful with it, don't let me mess you up. You know, continue to use candles, continue to do what you're doing, but if you're not successful or if something that I'm doing makes sense to you, then by all means incorporate a piece of what I do into it, okay? Can you actually make a living trading like pulling $8,000 a month? Depends on how big your account is, okay? I would say you need to have a realistic goal. I am swing to intermediate term trading. I might go sometimes several months without making a profit, or actually show a loss for several months. And then, bam, you hit it out of the park. You do exceptionally well for a while when the market begins to trend. Or you might just catch a couple outliers every now and then, and it makes you a whole year. That one little outlier trade I showed earlier went up, and it's $30-something thousand profit on a very small investment. Now, that's an outlier, and that's, let's just say results not typical. But you do catch, in general, you will catch one or two of those a year, and that does help to make a year. If you're looking for income out the market, I think you're looking at the wrong place to generate income. If somebody tells you you can generate income, I would run, not walk away. There will be losses, and they could be losses for extended periods of time. But longer term, I believe what I'm doing works very well, and I've been doing this for 20 years. And you could do quite well longer term. But I think it's a bad idea to look to the market for an income, meaning a steady stream of income. The income, so to speak, with my methodology and trend following tends to come in chunks, okay? So what I see happen a lot of times is people come in when I'm doing great, when the market's trending, and to a point where it scares me. They're like, hey, I might give up my real estate business and just do this trading thing. I just made 20% in 2 months. It's like, whoa, hang on. It's not always this good. And then what happens is the market will get choppy for a few months, and then they'll quit. And then what happens after that? Well, the market takes off again. They would have made another 20% had they stuck it out. But that's the hardest part, is you got to wrap your head around the methodology, know what you're doing. But if somebody tells you you can consistently make $8,000 a month, then why don't they make $8,000 a month and then just keep parlaying that in? Okay, so there's no guarantees in life. I was looking at somebody's stuff a while back. They said you could turn 5,000 into 500,000, and then you could do that over and over again. I'm like, okay, well. If it was that easy, everybody would be doing it. There's no holy grail, but there is conceptually correct, viable approaches to the market. And trend following and swing to intermediate term trading, I think, are the way to go. If you're new to trading, where do you suggest we start? I would start with trading only persistent pullbacks. Okay, I just trade one pattern, and then learn how to pick stocks. Take your time. Trade at a very small size. Trade at a size that's almost meaningless. As I preach, you didn't become a doctor, a lawyer, or an automatic transmission mechanic overnight. It took some time, so take your time with trading. Paper trade for a while, but realize, as I wrote in the Layman's Guide to Trading Stocks, that I've never met an unsuccessful paper trader, okay? So chances are you're going to be successful as a paper trader, so you need to slowly move that success into the markets and just take one pattern until you get good at that one pattern, until you're successful, and then slowly add on from there. And again, I can't emphasize this enough, make sure you trade at a very small size, a size that's almost meaningless, and then you're not going to have any of the psychological problems associated with trading at too big of a size, okay?
Hey Dave, you all ready to wrap it up?
Yeah, I'm good. I want to thank you, Reed, for having me. I appreciate it. Thanks to Traders Inspiration, and of course, thanks to all you guys for being here. I appreciate you taking time out of your busy schedule to be here. Anything unanswered, I do answer my own email, so shoot me an email, and I'll be happy to get back with you.